In this video, we're going to discuss the average returns we can expect when flipping vacant land. This is going to include both for cash sales and for owner finance sales. Hey, what's up guys? My name is Sumner Healey, founder at thelandpioneer.com. I buy and sell land on the internet. In the last 18 months, I've done a little over $2.2 million in sales, and I make these videos to share my journey and hopefully help others along the way. So I know we've got a ton of new people that have been watching these videos, and a common question that we've been getting is, I hear you talking about flipping land and all that good stuff, but what kind of returns are you getting? What's something that we can have in terms of like a North Star in regard to what to expect when flipping properties? Now, there is a lot of variance to the answer here, but I'm going to give you real data from the deals that I've done. At the time of this recording, I've done a little over 408 land deals, so I've got a pretty good backlog of data to go through. And this is going to cover both for the cash flips that we do as well as the owner financing. So one of the truths about flipping land is that there's an inverse relationship between price and ROI. What I mean by that is when we're dealing with lower end, cheaper properties, you're typically going to have a higher ROI in regard to a cash sale as well as owner financing. So in my experience, properties that are under the $5,000 purchase price, you can typically see 200 to 500% on cash flips, and anywhere between 500 to even 1,000% when owner financing those properties. Now, last year I did over 225 sales that pretty much just embodied that approach. We were flipping a lot of lower end properties because the ROI was so attractive. The reason being is that it's a very inefficient market in regard to those lower end, more entry level properties. Typically owners have no idea what they're worth. They don't really want them. It's just a random thing that they have to pay taxes on. So they're usually willing to take 10%, 20% of the actual value of the property in regard to an offer price. And then on the flip end, buyers don't really know what those properties are worth either. There's not a ton of comps to compare them to. And when you stack owner financing on it with good marketing, you're typically in a league of your own in regard to having any competition for those kinds of properties. Now, it's a great business model. It's a great way to build up a bankroll. It's a great way just to have a phenomenal return. And truthfully, I don't see anywhere else in the world of real estate where you can get a return that even matches that. The problem is one thing. One of the things that you'll learn while being in this business is that it takes the same amount of time to do a cheap property as it does to do a big property. In fact, in some cases, selling big properties is actually easier. And it's not just easier in regard to the selling, it's typically easier to buy because you can use title companies, you're typically dealing with professionals, you're typically going to have a buyer that's more sophisticated, more savvy. They've bought real estate before, they bought land before, so they know the process. And so in the last 12 months, we've really pivoted our business to go up market and go for higher quality properties. Typically, we're selling properties between $20,000 to $150,000 in regard to a sales price. So for properties that are $5,000 and above in regard to a purchase price, we typically find that on a cash sale, you're going to reasonably expect about 100% return. Now, of course, there's outliers here, and in some cases, we will actually take less than 100% return if A, we think we can sell the property quickly, or if it's going to be a really efficient way to exercise our capital. What do I mean by that? Well, if we have $500,000 for acquisitions, and I could go out there and buy $1,000 properties, or maybe I could buy two properties for $250,000 each, and each property is going to bring in 60% ROI or 70% ROI, I would actually typically do that second deal more times than doing the first option. Now, if you're first starting out, option A is going to make more sense because you're going to spread out your risk. You typically don't really know what you're doing, and there's a real margin for error there. But as you scale up, the idea of doing 500 deals versus doing 2 deals and exercising the same amount of capital, well, that second option becomes a whole lot more attractive. Because to run a business where you're doing that quantity of deals, call it 500 deals, you need serious infrastructure, serious support, serious manpower to handle all that comes with flipping 500 properties. So all that to be said, on the higher end properties, typically about 100%, but we will absolutely accept less if we can sell it faster or if it's just going to be an efficient use of our money. Now, on the owner finance side of things, it does range a little bit more here. We've had some owner finance properties that are bigger. Let's say we're selling them for $50,000, $75,000, $80,000, where we're going to net 300, 400% in regard to a return. I've also done owner finance properties at that higher tier where we're only going to make 200%, 250%. So what I've seen kind of as an average here is about 300 to 400% in regard to a return for owner financing those bigger properties. And so what I've found is I'm actually typically willing to accept a lower ROI on those owner finance properties for the higher tier, because what I found is it's actually not as difficult as you think to get large down payments when you're working with a pretty savvy buyer. Now, when you're flipping cheap properties, you maybe get 5% or 10% of the property's value as a down payment. And I used to think, well, that's probably going to translate to doing higher end properties. There's probably no wiggle room there. But you're working with a more qualified audience that typically has more liquidity. And I found that we're actually able to get between 20 to 40% of the purchase price as a down payment. And a lot of times that's going to get us 100% or 90% or 80% of our actual basis in the property back in one swoop. And so I'm actually willing to accept a smaller return because I can capture my basis back, and then really everything thereafter is gravy, or close to being full gravy. And by full gravy, I mean profit. So that really sums it up. You're gonna see a disparity between lower end properties and for the more expensive properties. As you go up market, the properties are more efficient, the spreads are gonna be a little bit tighter, but really it's a natural transition for a lot of people in this business, because ultimately it's just a lot easier to scale up and have a business that does $1 million, $2 million, $5 million profit a year when you're doing less quantity, higher quality. Now, there are folks in this game that do focus on lower end properties and they sell hundreds of them a year. I used to be that guy. And you can make a great living doing that. You can build an incredible business doing that. But for the goals that I had for my business and where I plan to take it, it just made sense to pivot, accept a lower return per property. But in exchange for that, I'm gonna have a business that can spit out more cash annually, just because it's a whole lot more efficient to reduce our quantity and have a higher quality for the properties that we're flipping. I hope this video helped. If you guys have any questions about land investing, throw them down below. I respond to every comment. And if you got value from this, please give it a thumbs up. And if you're looking for more land investing content, we've got an incredible backlog of videos that we're releasing. So be sure to subscribe. We got new content dropping every week.